Now this for you if you're trading short term, okay? By short term trading, I mean day traders and swing traders. So the first thing you need to look at before you enter a trade, very important, is to look at the trend. Not only in the current time frame, but also one time frame higher. So let's say if right now you're looking at H1 for entry points, okay? So you need to look at H4, the bigger picture, to see whether is it trending in the same direction as compared to H1. You want both to be trending in the same direction. You don't want to see things like, oh, this one is going up, H4 is going down. If you see this, wait, don't trade. If you want to double confirm things, you can look at one more time frame larger, which is daily time frame. Stop there. Bare minimum 3 time frames. How do you know whether the market is really trending upwards or trending downwards? You probably already know this, which is using moving averages. So for example, if you use 50 SMA, you want the smaller moving averages to be above your larger moving averages. So different people use different numbers, right? So let's say for example, you like to use 100 SMA, okay? You want the smaller SMA to be above the larger SMA. This is a bullish trend. On the other hand, if you have 100 above 50 and both are sloping down, it is a bearish trend. You should know this by now, okay? So if you spot a trending market, then you should apply trending market strategies, okay? You don't want to apply a consolidation or ranging trading strategy onto a trending market. It doesn't make sense, right? At the same time, you also don't want to apply a trending market strategy onto a market that is going sideways. So one very important thing, apply the right kind of trading strategy onto the right kind of market conditions, okay? So example of indicators in which you can apply onto a trending market, as you already know, moving average as well as Fibonacci, the retracement, okay, and also trend lines. Of course, there are many more. That's for another video. Let's say you have found a trending market, a good, strong, trending, bullish market. The next thing you need to look for is support resistance. Let's say if you want to buy over here and your target price is set based on risk to reward ratio. Let's say every single time you open a trade, you have to take a 1:3 risk to reward ratio, okay? But in between your entry to your TP, there is a very strong resistance zone. Are you going to enter? No. And one very important thing, a lot of retail traders, they only know how to spot visible support resistance. There are a lot of invisible support resistance. Example, fundamental support resistance. Example, supply and demand zone. These are what a lot of retail traders don't see. And the thing is, this also prevents you from entering into a trade, because if your TP target is over here, this is based on your trading system, but then there's a resistance over here. Your risk to reward is compromised. Are you still going to go in? No, right? So you give this trade a miss. But if you enter on a retracement and you want to enter right here, okay? And this is a very strong resistance which became support. By the way, a very strong resistance support is a zone which has been tested at least 3 times. Okay, by now you should know this. Let's say you want to enter here. Based on just this horizontal support resistance, is this enough? This is not enough. So that's why you need step number 3. Step number 3 is the confluence and confirmation stage plus confirmation. Okay, so confluence is basically like many layers of floor. So this is one layer. So maybe the second layer can be your moving average. Let's say a moving average goes like this, and also price came down here and test this moving average. Moving average, as you already know, is a dynamic support resistance. So one test on support line, support zone, second test on moving average. So you have 2 layers of flooring. This will increase your probability of your trade. So you can add one more. Example, Fibonacci. You want it to retrace to 50% level or 61.8%. Okay, so this gives you a 3-layer support. So this is what I mean by confluence. What does it mean by confirmation? So one thing you can use is momentum indicator. So there are a lot of momentum indicators. Some people use RSI, some people use McDonald's, MACD, some people use stochastic, some people use CCI. Did I mention that already? RSI, CCI, MACD, stochastics. Variety is the spice of life. Yes, indeed, but just pick one. Just pick one. Please, your chart is colorful, but it doesn't mean that it will make you money. So let's say, for example, you pick my favorite indicator, which is CCI. Okay, so when you see this 3-layer confluence, price retrace there, and give you one more confirmation, which is example, you have a bullish army right over here, or any bullish candlestick pattern confirmation. Okay, so that's a lot of confirmation. I cannot even keep count. You want CCI to be at the oversold level, preferably, ideally, going from oversold back into the neutral level. Okay, so as you already know, momentum indicators on top is overbought, area below is oversold. In the middle is what I call a neutral zone. So you want it to go from not neutral. So you want it to go from oversold back into neutral zone. So this is many confirmations. All these things increase your probability of getting into a good trade. But with that said, in the financial markets, shit still happens. Even with so many confirmations, yes, it is still possible that a trade doesn't go the way you want it to go, and it's just part of trading. So just give it, let it go. And one of the reasons why your trade might not work out despite all of these things happening, despite all the stars lining up, is step number 4. And what is that? That is news and earnings announcement. So if you are a currency trader, one of the economic calendars you can look at is Forex Factory. I find that it is very user-friendly for beginners to start with, so you can start with that. And if you are a stocks trader, please get out of the trade or don't enter the trade right before earnings announcement, because what happens is that the stock can close here today. If there's an earnings in between, it's going to get down, and if you put your stop loss over here, it's not going to get triggered. Then you wake up and surprise, surprise. So you want to avoid trading right before news, high impact news to be specific. Okay, so if you go to the calendar, it's going to be coded red color. Let everything go through first, let everything pass first. Then you can consider, okay, is there a good setup for me to go in? Because when you enter during a news, not only does your spread increase, not only does the risk of slippage increase, but also the volatility risk is going to increase. So no matter how good your trading system is, you trading around the news is not going to work out. So how can you check for earnings announcements? Some platforms, they have a symbol below. But then if you want to check it specifically, you can go to websites to check the earnings date. One of the financial websites you can go and look at is Yahoo Finance. Okay, it tells you the earnings date of the stock that you're looking at. Now the fifth thing to help you increase your probability, this is also another so-called confirmation. If you like to put it that way, it is inter-market analysis. Now this is what retail traders don't like. Oh my god, all this economic stuff. Because you need to know that nowadays markets are interrelated. When one moves, it's going to affect the other market. Now the thing is, hedge fund traders, it's night time already. Hedge fund traders, they conduct inter-market analysis. So should you. So I'm just going to give you a couple of currencies as an example. Okay, so let's take Aussie dollar. If you trade this currency, so what are some of the things you should look at? Other types of market, you should look at gold prices, because Australia is a major exporter of gold. So gold prices is going to affect Aussie dollar is going to affect gold prices. If you are trading USD, you should also look at gold prices because these two are also interrelated. So most of the time, gold prices is inversely proportional to USD. Okay, so USD normally most of the time is inversely proportional to gold prices, commodity prices. But during times of crisis, for example, recession, Eurozone debt crisis, you realize that it moves in the same direction because of many different reasons. One of the main reasons is the safe haven status of these two. And if you are trading a currency, for example, Euro, Yen, okay, so let's take Euro, Yen. Generally, Euro is considered a higher risk currency as compared to a safe haven currency like Yen. So if you compare it to the stock market, you realize that they tend to move in the same direction most of the time, okay, most of the time. So this means that if Euro, Yen, this whole entire currency goes up, S&P 500 is going to go up as well. Because as you already know, stock market is considered a risk market where during risk on environment, capital is going to flow to stock market and hence into euro, dollar as well, and away from yen. That is why capital outflow leads to yen going down and hence the whole entire currency going up. Understand? Give you another example. If you are trading a currency like Canadian dollar, for example, okay, Canadian yen, sorry. If you're trading Canadian yen, you might want to look at oil prices because one main thing is that Canada is a major exporter of oil and Japan is an importer of oil, and hence when oil prices go up, Canadian yen is going to go up. So what if you're trading, example, pound yen, okay, pound yen. It's very important for you, okay, let me just write properly. It's very important for you to look at the stock market of the currency in which you're trading. If you're trading a UK currency, then you should look at the UK stock market. You should look at London Stock Exchange listed markets. Alright, so a lot of people say, oh, look at FTSE 100. A more representative index would be FTSE 350 because it is a combination of FTSE 100 and FTSE 250. This is a better sample size as compared to FTSE 100, which only comprises of 100 UK stocks measured based on market cap. So if you're trading Canadian dollar, then you should look at the Canadian stock market. If you're trading yen currencies, then look at Nikkei, Japan stock market. Nikkei 225. Okay, look at Nikkei 225. If you want to avoid looking at other things, you don't like commodities, bare minimum, look at the stock market if you are a currency trader. And since you're looking at the stock market, there are also other markets that is going to affect the stock market. So you gonna still look at something beyond the stock market, you know what I'm saying? So if the stock market goes up, bond yields will be up, okay? Bond prices will be down. And bond yields is one of the ways in which you can determine market sentiment, to determine when a recession is going to come, okay? I've already covered this. I'm also going to do a bonds basic course on this channel soon, so stay tuned for that. So if you want to know more about support resistance, if that part just now confused you a little bit, and if you want to learn more about intermarket analysis, I'm going to put them right here so you can go and check it out. So with that, talk to you in the next video. Bye.